Investors are really double booked. So they've got one eye on Capitol Hill and what Aisha's just been discussing, and the other on corporate cash flow, because both have the power to push stocks in one direction or another. Major earnings reports are about to splatter all over the screens. After the bell today, AI data center infrastructure darling CoreWeave, Paramount, Skydance, Occidental Petroleum, and quantum computing systems maker Rigetti all open their books. Ahead of it, we've got CoreWeave, Paramount, and some of the other names moving higher. Others reporting this week: small nuclear reactor designer Oklo, Cisco, Bath & Body Works, Walt Disney, MetLife, JD.com, Applied Materials, and Ross Stores. Those are among the names that could give investors a window into the health of not just their own companies, but their respective sectors. And you know what? Health of any company or sector is always a moving target. In his annual Thanksgiving letter released today, Berkshire Hathaway CEO Warren Buffett, arguably the greatest investor of our time, reminded us of that. The Oracle of Omaha, for those of you who don't know, took control of Berkshire in 1965, then a near-bankrupt textile company, and over the decades turned it into a $1 trillion conglomerate. In the letter, he emphasized how strong he believes Berkshire will be in the future with or without him. And he goes on to say, Berkshire has less a chance of a devastating disaster than any business I know. And Berkshire has a more shareholder-conscious management and board than almost any company with which I am familiar, and I have seen a lot. Our stock price will move capriciously, occasionally falling 50% or so, as has happened 3 times in 60 years under present management, meaning Warren Buffett. Don't despair. America will come back, and so will Berkshire shares. So at a time when valuations are currently stretched, but the market is charging higher, as you can see, I mean, look at the NASDAQ up 535 points. Buffett's emphasis on calm and caution should be a lesson to investors right now. Let's get right to the floor show. Joining me now, Regions Chief Investment Officer Alan McKnight. Alan, Warren Buffett's been a seller of stocks for the last 12 quarters. He has, of course, held on to a huge portfolio of many stocks, but he and his team have continued to raise cash. He's waiting for a big correction to put it to work. Is that the right strategy? Because if you look at the 12 quarters of the S&P, it has jumped about 82% here.
We think that he's been doing the right thing in terms of trimming some of his exposure, but he still believes in this mantra of, in the short run, the market's a voting machine, but in the long run, it's a weighing machine. So keep a hold of those winners and those names that can continue to drive earnings growth. But don't be afraid to trim a little bit along the way. Don't allow yourself to get overly or overweighted to any one name.
Have you been concerned at all about these rich valuations? I mean, we saw suddenly the world pivoted and they went from being a huge, say, for example, Palantir bull to a little bit of a Palantir bear last week. Of course, Palantir's jumping again and now at the top of the NASDAQ at the moment. But you know, this is a very fickle market, and we know that the herd can change direction at the snap of a finger.
Without a doubt. I think the reality is that the market is incredibly fickle right now, and we see that a lot when valuations are this high, because any bit of news is going to turn both to the positive like we had today or to the negative like we had last week. And so our view is that you can't try to time that. You just need to keep buying companies that have the ability to generate earnings over the long term and not get too caught up in the short run, and then make sure you have a diversified portfolio.
Okay, well, that is at the very basic advice that everybody always gives. So I need you to dig a little bit more deeply, Alan, and tell me, let's just say people are still stuck on the Mag 7. Which Magnificent 7 names do you feel are at better valuations, not as, you know, cream and sugar?
We always love the cream and the sugar, especially for the holiday season. So we still like Alphabet. We think it's still trading at a reasonable multiple. We know that it's had an amazing year to date, but we think based on the search capabilities and AI capabilities, it's really well positioned. We like Microsoft. We think that it's going to continue to drive growth over the long term with its platform. It's investing in the right places. So those are a couple of names where, yes, they have gone up in price. Yes, they've had an amazing run over the last couple of years, but the earnings growth behind them is still incredibly strong.
I mean, Google, Alphabet is up 4% right now. Of course, they announced that Gemini for television is starting. So again, it's very much an AI story. As you look at the NASDAQ gaining at this moment 533 points, anything that you look at and say, I still like certain things that haven't quite reached their potential yet?
Well, we think that there are actually some opportunities in some of those underloved parts of the market. So we think within certain sectors, say energy, which we think can do well over the long term, but in the short run is a little challenged by oil prices. We think consumer staples, and specifically names like Walmart and Costco, that have incredible moats around their businesses, to borrow from Buffett. And then over the long term, we also think that as long as earnings continue to drive in some of those other sectors, we'll see a broadening of the market. We think that mid-cap names can also do well. And I think they haven't gotten the love this year, but we think it will broaden out next year as we start to see a little additional growth in the economy.
All right. Good to see you, Alan. Thank you very much.
Always a pleasure.
Alan McKnight.